Hello and welcome back. Today's story is more than just policy, it's about paychecks, livelihoods, and the people behind the numbers. If you've ever worked in a restaurant, a bar, a salon, or even behind the wheel of a rideshare car, what we're diving into today might directly impact your wallet. We're talking about the No Tax on Tips Act, a piece of legislation that just passed the Senate unanimously. Yes, you heard that right. In an era where political division seems to dominate the headlines, this bill received zero objections. But what does that actually mean for you? For millions of workers across the country? Is this a game-changing win or just another temporary fix? Let's unpack it, together. At its core, the No Tax on Tips Act proposes something fairly straightforward. It allows eligible workers to deduct up to $25,000 in tips from their federal income taxes. That means if you're a tipped worker, someone earning gratuities from customers, this could significantly reduce your taxable income. And that deduction includes tips received through cash, credit cards, or any other payment system processed by your employer. Let's paint a picture. Say you're a server who earns $45,000 a year, with $20,000 of that coming from tips. Under the new law, you could deduct that entire $20,000. If you're in the 22% tax bracket, that's roughly $4,400 in tax savings. Think about that. That's 1 or 2 months of rent. A car payment. A student loan bill. Or just some breathing room when the groceries and gas prices keep creeping up. But here's where it gets a little more nuanced. Not everyone who receives a tip will automatically qualify. First, your total income must be under $160,000, a cap that leaves room for a wide range of workers, from part-time baristas to full-time stylists and seasoned servers. Secondly, your occupation must be classified as a traditionally tipped position, based on data available through the end of 2023. So if you just started getting tips in your job recently, like a cashier at a coffee shop where tipping jars became a trend during the pandemic, you might not be included. Within 90 days of the bill becoming law, the Treasury Department will publish a formal list of qualifying job categories. So, clarity is coming, but for now, there's still a little uncertainty. The impact on minimum wage, and why it still matters. One thing the bill does not do is change the tipped minimum wage, which at the federal level is still $2.13 an hour. Yes, you heard that right, $2.13. That number hasn't budged since 1991. The justification has always been that tips will make up the difference. But as we all know, reality doesn't always align with theory. In slow seasons, or in low-traffic areas, many workers find themselves scraping by, regardless of their hours. So while the tax break may help, it doesn't fix the underlying issue of low base pay. That remains another battle entirely. So why now? Why is Congress, so often gridlocked, suddenly aligned on this? Well, part of the push is political. Former President Donald Trump introduced the idea during his 2024 campaign, presenting it as a direct way to support service industry workers, especially in states like Nevada, where tips are essential to income. But beneath the surface, as with any bill, the conversation gets more complicated. Supporters of the bill argue it's about fairness, a long overdue nod to the hardworking people who live paycheck to paycheck. These are people pulling double shifts, often without health benefits, juggling irregular schedules, and dealing with customers face-to-face every single day. Giving them a break, letting them keep more of what they earn, feels like the least society can do. But critics ask an important question: is it really fair to everyone? Imagine this scenario. A cashier and a waitress both earn $35,000 per year. Under the new law, the waitress could receive a major tax deduction because part of her income comes from tips. The cashier, who deals with just as many customers, gets no such break. And here's another concern: employer behavior. With tips becoming tax-free, some employers might lean even harder into a tipping culture and shy away from raising base wages. After all, if workers are keeping more of their tips, why increase their hourly pay? That's a longer-term consequence worth keeping an eye on. Tipping, while normalized today, has a complicated and often uncomfortable history in the U.S. Its origins trace back to the post-Civil War era, when employers used it as a way to avoid paying formerly enslaved workers a full wage. Over the decades, it morphed into a cultural norm, particularly in hospitality and beauty services. But the economic structure has never been particularly kind to the workers. And that's why this new law is such a big deal. It doesn't erase the past, but it attempts to rebalance the scales, even just a little. Right now, the IRS mandates that any tips over $20 per month must be reported. Cash tips often go unreported, either due to forgetfulness or a lack of formal tracking. With this new deduction in place, workers now have a stronger incentive to report their tips accurately. Interestingly, this bill doesn't just benefit employees. It also expands something called the Section 45B tax credit, which helps employers offset the payroll taxes they pay on tips. Before, this mostly applied to restaurants. Now, it includes salons, spas, and beauty service providers, a move that could help small businesses stay afloat while still supporting their teams. So, it's not just a win for individuals, it's a potential boost for small business owners as well. Of course, this kind of change comes with a cost. According to estimates from Yale's Budget Lab, this law could result in $10 to $15 billion in lost tax revenue each year. Will people be more inclined to tip generously if they know the worker is keeping more of it? Will businesses start advertising it, posting signs like, "Your tip goes further, tax-free"? Maybe. But that runs the risk of tipping culture becoming even more aggressive or expected, in roles where it wasn't traditionally the norm. And that could raise a whole different set of challenges. At the end of the day, this law touches something very personal, our money. Whether you're earning it, spending it, or saving it, how much of it you get to keep matters. If you're a tipped worker earning under $160,000 a year, this bill could put more money back in your pocket, starting next tax season. But only if your tips are properly reported. Your job is on the official list from the Treasury. And you're prepared to track your income more closely. If you're an employer in hospitality or beauty services, you may find new incentives to structure compensation and payroll differently, though you'll also need to stay compliant and possibly consult with tax professionals. And if you're not a tipped worker, this still matters. It's a rare bipartisan win, a policy with the potential to shift the way we think about labor, equity, and compensation in America. Have you worked in a tip-based job? Are you currently in one? Do you see this bill as a long overdue correction, or does it leave more questions than answers? Drop your thoughts in the comments. Your experiences and insights shape how we cover these stories. And if you found this breakdown helpful, consider subscribing. We're here to help you make sense of the changes that affect your income, your rights, and your future. Thanks for listening, and until next time, take care of yourself and your money.